I would say asset classes don't die; they just go to sleep for a while. Companies do, and that's where do you want to put if you only owned say? And I think people think they diversify by owning the Nasdaq or the Russell 1000 growth and the S&P 500 or whatever it may be. But do you want to put your future and your family's future in the hands of a few companies? Having done this for 31 years, I have a little secret for you all. If I knew exactly what was going to happen on Thursday before Labor Day weekend, I would not be doing this interview. And so that's where I think diversification, to me, still is the best path for dealing with multiple paths forward, which I think now more than ever are out there. Less than 50% of industries are hiring. I think it's 46.8% the last 2 months, the last 2 months in a row. And if I look historically, when we get this narrow, historically, you've been in or near a contraction. I fear right now that a lot of Wall Street thinks they exist to help people take risk. And I don't think people need help taking risk right now. I think they did prior to 2020, 2021, 2022. But I think now people need someone to kind of make sure that they're staying truer to their risk tolerance.
Hi, Brent. Welcome to Excess Returns.
Thanks for having me.
As CIO at Northwestern Mutual, you spend a lot of time researching the markets, and I think your insights are important in helping shape how your wealth managers and your investment teams build portfolios, make allocations, and advise clients. And so what we wanted to do with you today is kind of sit down and hear your perspective on a number of topics, including market valuations, the risks of market concentration, the role of macro forces in the markets, why diversification may matter more going forward than it has in the past. A lot of these topics are things that you've written about. You can find Brent's articles and commentary underneath the market commentary section of northwesternmutual.com's website. You put out your quarterly letter along with weekly pieces that, I think are valuable and investors in our audience can learn from. So looking forward to a good discussion with you today.
Perfect.
You recently said that both sides of the Fed's mandate are possibly at risk here. So that's possibly higher unemployment and higher inflation. Can you just kind of walk us through that and sort of paint the picture here for what you're seeing right now?
Yeah, this is where I think the question of tariffs and what do they cause is still a wide open question. And you have smart economists on both sides. And so if you think about a tariff, it's essentially a tax, or that's what many people believe, and a tax typically would lower economic growth. I think the risk is that you're towards the end of an economic cycle. And so typically towards the end of an economic cycle, inflation is higher, it's stickier. The Fed hasn't returned inflation back to its 2% mandate since 2021. And this is where the risk is that, the other offsetting factors that the administration is involved in, the OBBA, deregulation, threaten to stimulate the economy a bit. Perhaps if the Fed cuts, it stimulates a bit. And that's where you have the risk of a potential one side, which I think is likely, that you do have lower economic growth, perhaps a labor market that falters just a bit. All the while on the opposite side, you have inflation moving higher. And this is the question of, is that inflation sticky or does it stick around? What does the Fed do? And that's where I think there's risk to both sides of the mandate, which from a portfolio construction perspective, just means that you have to hedge both sides a bit. And that's where I think investors have to think differently. They have for the past 15, 16 years prior to 2022, where you really only had to hedge the one side of the Fed's mandate that was at risk all the time, which was essentially not meeting their inflation target. And so that kind of ties into how I think it's just a bit different of a time period. But we're going to find out what happens with tariffs and what do they actually cause. And that's where I think there's some volatility ahead.
It is kind of amazing that regime change from those many, many years of, very low inflation, below 2% to where we are today. It just goes to show you that in markets and over time, things can be very different. But as investors, we tend to often be fighting the last battle and we're grounded in sort of only what we know or have experienced.
100%. I think people draw trend lines forever, and that's the risk. Having done this now for 31 years, entering my 31st year, I think about all the times in the past where everybody knew what was a no-brainer. And oftentimes I always love the joke that people have to admit that they weren't using their brain when they made that comment. And typically, I've seen different asset classes that were going to outperform forever, and hopefully we'll get into some of those commentaries, because doing this for 31 years, you hear reasons why, for example, mid-caps back in the day. That was the asset class everyone wanted to love. They were going to outperform because you had the best of both worlds. You had the fallen angels from the S&P 500, and you had the winners from the small cap area, and they met together and they provided this great asset class. And that's where I just think people kind of use recency bias, and that informs their decision-making going forward. And to me, there can be trends for some time, but they don't last forever. And it's really the seeds of whatever, as you mentioned, we were fighting before, often becomes, I suppose, the fire of whatever we have going forward. And this is where I think investors have some learned behavior about buying every single dip because the Fed or fiscal policymakers are going to run into the fire and kind of throw flames on any economic problems we have. And that's why I was kind of known as a permeable, I think, for many of my first years at this company, to where now I'm a bit more cautious just because we are towards the end of a cycle. And will that be available in the future if we continue to run deficits like we are, and if inflation is an issue, which I think it is pushing forward? And that's quite a bit different than the past 15 years prior to 2022, plus the reality that we're not going back to 0% rates. And what kind of oddities did that stoke that we're probably still living with?
Jack, I guess you can't use the permeable on the YouTube cover for this one.
Unfortunately, I don't know. I don't think I'm pessimistic. I think I'm just reasonable and rational and balanced. And that's where I think there are just different risks than there were back in the day, kind of coinciding with that risk comment that I made about where the risks are. But it's certainly a different environment. And that's where, you talked about diversification. That's where I think it becomes even more important because there are multiple outcomes, even from the point at which we sit today, that are likely feasible. And that's where, I think it's hard for anyone to know exactly what's going to occur because we really haven't done this tariff experimentation for over, since 1933, if we get to the rates that we're thinking we're getting to.
Well, it's funny, we don't do this, but it's not the permeable YouTube cover that would get tons of people to click on this. It's the perma bear YouTube cover with basically like flames shooting around you. Like that's what people love to see on YouTube. They want the negativity. They want the market going down.
Yeah.
We're not going to give it to them, but they do want it.
I feel like I'm the middle child, so I'm all about balance. And that's where I think having kind of your outlook and kind of the framework of how you look at the world and then actually using that as a discipline tool, not trying to find data that supports your viewpoint, but what is the data actually showing you, and having some sort of process that you use to kind of identify where things are at. And no one knows exactly when that's going to turn, but I just think the risks are different. If you look at any version of an economic cycle, there certainly are ones that you can look at. That's called the output gap. That is closed. The unemployment rate is low. And that's where the commentary comes back to. That's historically at the end of an economic cycle. And that's just where you have to be careful because no one tells you exactly when the economy might turn down, which is the point at which you just want to make sure that you're being careful and you're diversified.
What is your reaction to Powell's speech at Jackson Hole, both from the perspective of, where he kind of pivoted here on rate cuts, but also if you have any thoughts on the abandoning of the average inflation target sort of stance that they've taken for a while?
Yeah, I mean, I think, and my thought has been, especially with the pressure that's out there and kind of where we are as a society, I know we think we had an inflationary time period, and we did, but it wasn't the 1970s. And this kind of goes back to your talking about how we're continually thinking about the last few years and the last cycle. We really haven't had inflation for quite some time. And so to me, the Fed is going to err, especially in today's world, on the side of the labor market. And that's where I think their pivot was. The minutes came out a couple of days before where most members, or the majority of members, actually thought inflation was a higher risk than the deterioration of the labor market. And then we had those non-farm payrolls, which were revised heavily. I think the question was, would he pivot? And he did. I think he left himself a bit of room in the committee, a bit of room by talking about inflation wasn't all going to come at once. And so kind of a commentary, I think, meant to be that even if inflation goes up in September, August, before we get that the Fed meeting, if the labor market show weakness, they would go ahead and cut. And so that's where I think there's risk going forward, just because we haven't returned to 2%. We saw what happened last year when they cut rates to the long end of the curve. And that's where I'm not surprised they're erring on that side, because I think that's the side that people are most acute to, with the great financial crisis not being long ago, and people just hiring people back from COVID and thinking about that other inflationary time period. I think anybody in this business thinks, yeah, those are out there. That inflationary time period's out there, but is that really ever going to happen again? And that could be the seeds for allowing it to actually happen again. But that's where I just think the Fed is more towards erring on that side of the equation. From the standpoint of average inflation, I mean, that was kind of a concept they used for a little while. And then they got a lot of inflation, at least in a shorter period of time. They didn't like it. So I think they're just pulling that back a bit. I don't have too many thoughts on what that means longer term. I think it's more about what happens in the here and now. And certainly there's a lot of movement going on at the Fed right now.
So what are your thoughts on cuts? I mean, do you think that there's a likelihood they're going to ease, or you're saying it's kind of more dependent on what they see in the labor market, and then from there, that will determine their sort of reaction?
I think that you tell me what the jobs number is next Friday, and I'll tell you if they cut or not.
Okay.
Me, and this is where I was a person during COVID that believed inflation would come down because it was tied to COVID. And then my forecast shifted a bit as we went through this. I think I called it the space between. I like music titles for whatever reason. My format shifted a bit because we were towards the end of an economic cycle where services inflation becomes stickier, where wage inflation actually rises. I could show you a chart that the Fed since the 1990s, late 1980s, has always raised rates. Typically, the top end of the bar has been when wages average about 4.2% year over year. That's a sign of a later cycle economic cycle where the Fed worries about a wage price spiral, because that's what happened in the 1970s. And so I have always thought the last mile would be incredibly hard, and it has proven to be hard. And this is where these tariffs are coming on now, which are raising goods inflation, which even that 1.2% year over year goods inflation that we have right now, I don't think people realize how little goods inflation we've had for the past 25 years. You didn't have a 1.2% year over year number on goods inflation from 1999 to 2009. And besides COVID, you have to go back to 2012 to find one. And so if that goods inflation is rising, what happens if services inflation is stickier? And perhaps do people like you all or people like me go to our employers and say, we need raises, or do you set prices differently? And that's where I think there's an inflation risk. And so to kind of come back to your question, I do believe if the labor market weakens dramatically, the Fed will cut. I still believe that absent any sort of dramatic pullback in inflation or any economic contraction, I think the Fed is going to struggle to cut rates markedly from here.
Justin, I'm going to need a raise.
There you go.
Now that you brought that up,
Listen, I showed this to my boss too, so hopefully he's listening.
well, we'll make sure it gets on his desk.
The other thing I was going to say is, Brent, if you ever, hopefully, I'm jumping the gun here, but hopefully you do come back on in the future. And if you do, our other co-host, Matt Ziegler, who's a walking like music historian, and music titles come in multiple times during every podcast, we'll have to get you two together, because I think it'd be a lot of musical references in that one.
I mean, mine are varied. I've had 2 out of 3 Ain't Bad by Meatloaf, I think. Steelers Wheel, Stuck in the Middle with You back in the day, where I had Clowns to my left and Jokers to my right. Is that right? And GDP was kind of just stuck. COVID, the end of the year COVID one was once in a lifetime, same as it ever was.
Oh, nice.
I know, because COVID was something that I had never seen before. And that's where I think people pondered, what do you do? How do you behave in this environment? How do you react? And the answer was the same as it ever was, sticking true and staying true to your plan. And, that's where I just think music titles oftentimes kind of give people a flavor that they can kind of sing along with me, maybe, about what my thoughts are and why.
I'm just happy I got the Dave Matthews Band with the space between, because when Matt does them, I can never guess the band. So at least we went kind of down the middle on that one.
We had the space between fears, I thought we'd have inflation fears, they would subside, and then we'd have economic contraction fears. And certainly we've had those, but we haven't had one yet, which is why I think people are largely writing it off. Back to your kind of learned behavior recency bias. I mean, there are a variety of indicators for the past year and a half, 2 years, that historically have been accurate indicators that have signaled potential labor market weakness or economic contraction, and they haven't come to fruition. And those still are flashing, yellow, if not even a little bit more red. But that's where I think, people just are shrugging those off as if it won't happen because it hasn't yet.
How do you think investors can put the Fed independent stuff in context? I mean, we don't do political stuff here, but by the same token, people on both sides of the aisle, I think, want to believe that the Fed is independent and they're making decisions on their own. And there certainly is some pressure. I mean, we're, as we just got on here, they're announced as a court hearing tomorrow on the firing of one of the Fed governors. Like, how do you think investors can put that into context, this idea that the Fed's under all this pressure?
Yeah, I mean, it's certainly one of the larger implications of whether or not we have inflation or not, I think. I mean, because certainly most politicians, and this is a bipartisan comment, don't want the Fed to give hard medicine to the economy. And that's where I think that's a kind of a forever comment. And that's where I think monetary policy, to the extent it possibly can, or the Fed to the extent it possibly can, and I don't know historically what phone calls happen late in the night or what doesn't. In today's world, they're on True Social, which I think makes them more reactionary for people to think about, but maybe those happened in the past too, I don't know. But I think it's a very important part of how we behave as an economy, how we think about things. And there's always been this question, even during COVID, if you think about on the opposite side of this, do policymakers, fiscal and monetary policymakers, act in the same direction? Is that more powerful? And that was the commentary post-COVID, like maybe they both can act together instead of fighting each other, and then we'll actually get economic growth. I just think longer term, I think what's probably served as the best would continue to serve as the best in the future, and hopefully that's where we'll end up.
You had in one of your commentaries, I believe you wrote about something about how less than 50% of industries are hiring right now. And that gets to kind of this idea of like the economy is doing well, but it's only doing well in certain areas. And like behind the scenes, we've talked about like a hidden recession in other episodes. What is your take on that whole concept?
Yeah, I think hopefully back in the day, I was the first one to talk about rolling recessions because you've certainly seen them. I mean, you have seen a bifurcated economy, and this is where I think you've seen a bifurcated market the past couple of years. And so as we talk, you're going to figure out that I think the economy and the markets are the same. Some people just don't do enough research and figure out how that ties together. But kind of back to what usually happens at the end of an economic cycle. At the end of the economic cycle, the Fed is usually raising rates because they're either fearful that inflation is on its way or it's here. As the Fed raises rates, it hurts different parts of the economy at different times. And so if you think about that, it hurts small caps or smaller companies. It hurts manufacturing. It harms the housing industry. And typically you get to a point kind of tying into your industries and people that are hiring to where you have enough of these industries or sectors and they're narrowing. You have critical mass to where you topple enough of the economy into a labor market decline that you get a recession. I think this time what's happened, and this is similar to what I'll tie back almost everything to 1999, 2000. This is similar to back then where you all were probably worried about would your computer turn on when the digits went 00 from 1999, and what would happen with the internet going forward. And that's where I think that spending back then kind of made that cycle go into economic cycle over time. And that's where we also had a really narrow market. So this time, I think you've harmed various parts of the economy, but you never got quite past harming enough because that AI spend has been so strong the past 2 years. There's obviously been some government stimulus thrown in there too, but this is where, the past couple of years tying into the market, you've had those stocks do all the heavy lifting. So the S&P is up 25% each of the last 2 years, 2023 and 2024, but less than 30% of the companies have actually outperformed the actual index, which is historically extremely narrow. And that's where, if you look at a chart that I can present, if you go back in time and you look at that to 1973, a year which I'm actually partial to because it's when I was born, you can look back and see that 1998, 1999 were the only other two time periods that were this narrow. 1980 was narrow, that was before contraction, and then 1973 was really narrow. And this ties into like all the different things that are out there, the high end versus the low end consumer. The low end to middle income consumer has been harmed because they have auto loans, they have credit card debt, they have student loans. Upper end consumer, not so much. They probably have savings that are paying a stream of income right now, which is a novel concept that we didn't have for 15 years. They may have a fixed rate mortgage. And so it also ties into that labor market where you're seeing, and this is one of the indicators I look at, because I do think it shows how narrow the hiring has been. I believe the past 3 or 4 months on a 1 month basis, less than 50% of industries are hiring. I think it's 46.8% the last 2 months, or the last 2 months in a row. On a 3 month basis, we're sub 50%. On a 6 month basis, we're at 51% or something of that nature. And if I look historically, kind of back to those indicators that I mentioned before, and this only goes back to the 1990s, I believe. But if you go back to then, when we get this narrow, historically, you've been in or near a contraction. And that's where I just think tying this all together, we're either going to have to broaden out from an economic perspective, which I think is what's hopeful, or that's where, how long can we continue with just AI kind of driving the economy forward? And I think that's the question that's out there that I have.
I'm curious, this is a little bit of a tangent, but what are your thoughts on this idea? You seem to hear from everybody who has kids that are graduating from college right now that like they can't find jobs. And I think the data backs that up. You can correct me if I'm wrong, but like unemployment is higher there. I don't know if that's AI related or what it's related, but do you have any thoughts on like what might be driving that?
I think it's probably a little bit of each. And so I do think the labor market has tightened or has loosened quite a bit to where I guess it's loosened up. It's harder if you get, and you can see this in claims. So initial jobless claims aren't all that high. So it's been low firing, but it's also been low hiring. And once you get laid off or let go, continuing claims are rising and then eventually people drop off. But that's what you're seeing across the board. And I think that's probably impacting some of those college graduates, as is perhaps AI. I know the Challenger job announcements, which come out next week, are hiring announcements or firing announcements, either way you want to call it. They do have a question on there usually about how much AI has impacted the lack of, or actually I think firings, job cuts this year. And it's ticking up, but it's still not a ton. I think we're still in the early part of what AI actually does. I just think companies have kind of been right-sizing their labor force a bit. There hasn't been a ton of hiring. And certainly I think that impacts college graduates the most. I don't have any of those yet. I have actually a sophomore and a junior in high school. So I suppose I'll figure that out in the next couple of years. Hopefully the market broadens back out and their prospects also broaden back out.
I want to go back to the economy. I wanted to ask you about recession indicators because, and this sort of plays into what you were talking about before, but it seems like, these recession indicators all started flashing a while back. You had tons and tons of people saying, we're going to get a recession, and it just didn't happen. And I'm wondering, do you think like something post-COVID changed? Is the stimulus? I mean, do you think something has happened that's maybe made these indicators less reliable, the yield curve inversion and things like that, than they were in the past?
Possibly. I just think it's that AI commentary that I messaged before that isn't really in those indicators per se. And that's where nothing's a perfect indicator. Leading economic indicators, for example, relative to coincident, the chart is straight down. We've been kind of in this odd period of time for so long, and there was a ton of money pumped into the economy. If I don't mention this meme coin, I think the people who follow me quite often will be disappointed. I mean, when you have a thing called fart coin, for example, which is a childish coin, but it had $1.6 billion in it, a few months ago, and it started at zero, and its sole purpose is to make you laugh. That's where I just think you're seeing a lot of money that's still out there. The AI spending has been so strong. And that's where I think, it's probably taking longer to get to where we might end up. And you've had that bifurcated economy where the higher end consumer, quite frankly, matters probably more to economic growth. It actually has held in there well because they haven't been impacted by higher rates because most of us have fixed rate mortgages, or most people do. And then you just contemplate the stock market. I mean, the market is 2 times as big as the economy right now. Kind of taking you back to 99, 2000, that was a fairly mild recession. Was that caused by business investment being pulled forward, kind of like today? Was that caused by a market that eventually faltered? And that's where I think there's probably some wealth effect, not just in those coins that I mentioned before, but also in the stock market, where it's kept people spending, it kept people wealthier than they otherwise would be. And that's where I think there are just risks going forward. And so I advise people to still pay heed to them. I think it hopefully, drives at least people to follow their plan. My big thing right now is people not concentrating, because at least historically, the winners today are not the winners of the next cycle. And that's where I think we do have an economic regime change going on right now, whether or not we have a recession, which typically is the point at which these things change, because whatever's in excess in the economy is usually in excess in the market. And that's where I think we'll have different leadership going forward. But that's where, my fear is that people have become emboldened in the market, are not only concentrating, but taking more risk in overweight equities a lot more than they otherwise would be, because households right now have the highest, I believe, allocation to equities, at least going back to the 40s when I can measure this. It's not necessarily a bad thing. It's just where are we at and where do we go from here? And when you add in valuations that are probably the second highest, going back to the 1880s, based upon a variety of different metrics, that's where there's at least reason for some caution and reason to pay heed to those different metrics.
I always hate these questions about like, what's the one indicator you look for? But so I won't ask that question. But in general, like as you're thinking about the risk of a recession going forward, are there certain things you like key in on? Are there certain things you look at?
I look at a broad mosaic. And so this is where I don't think there's any one perfect indicator, and you always have to put things into context about, what's out there right now and what has changed and what hasn't. And it's a preponderance of evidence type of equation. And that's where, I think if you do it that way, you're less beholden to any one particular indicator. But certainly that's where, I think there's enough still out there that could cause some angst going forward. And I boil it down to even this right now. I mean, we're going from 2.3% average effective tariff rate coming into the U.S. at the end of 2024, now up to 18.6%. I think this is where the market has kind of said, coast all clear, like nothing bad has happened yet. And that's where these tariffs haven't been on long enough because of the pull forward of demand from consumers, the pull forward of demand and inventories from corporations and importers, and the reality that most of them, just started taking effect. And we're going to get to 18.6% if they all go in place, and that is a moving target. can the economy absorb that all in a short period of time, along with all the other changes that we've talked about? Not a good or a bad, just a lot being thrown at all at once. And that's where I think you don't want to look at any of my other indicators, at least contemplate that question. The good news is longer term, the U.S. economy is dynamic. It'll evolve around it. Like I thought we'd evolve around COVID if that became our new normal. But can we get to that other side without a hiccup? And that's where I think there's still an open question there. And that kind of ties back to that. Is it more of a downside to economic growth? Is it more of an upside to inflation? Would it be both, which would be the most unfortunate one of all of them? And then how do we kind of get to the opposite side, which I think there's still a risk that there is some sort of a hiccup. Just for perspective, the average tariff rate, the effective tariff rate as of June, which we'll get imports tomorrow, so we'll be able to calculate it. And this was according to, I believe, Wharton Penn was around 9.1% in June. So we're not all the way there yet. And that's where I think you still have room to go. And you're seeing companies have to replenish inventories that they might have built ahead. So we're going to find out in the next few months. And that's why I kind of think we're at a critical point. I would just urge everyone not to sell equities, not to do anything else. Acknowledge there's uncertainty, but the way that you acknowledge there's uncertainty is not through concentration, which to me, I always tell my clients and advisors, that to me is you thinking you know exactly what's going to happen. And having done this for 31 years, I have a little secret for you all. If I knew exactly what was going to happen on Thursday before Labor Day weekend, I would not be doing this interview. And so that's where I think diversification to me still is the best path for dealing with multiple paths forward, which I think now more than ever are out there.
Well, we're happy you did it because I don't think the people want to listen to Justin and I talking to each other on the Thursday before Labor Day weekend. But I think it's an important point because we're in such a polarized world. And when people look at something like tariffs, you've got the people on this side that it's a complete catastrophe and this side means nothing. And like you said, we haven't seen this what are we talking about? Like Smoot-Hawley from like way back of the century or like a long time ago.
Estimates higher. Yeah.
Yeah. In a completely different world. I don't think any of us know like what this is going to look like. All we could do is look at the facts and try to do our best with it. But this is an incredibly challenging thing with an economy with a lot of moving parts, trying to figure out like how these tariffs are going to impact.
100%. It's a large dynamic economy and it's a large global economy. This is all globally interconnected and all the different outcomes are I think rather unknown. So, and there are smart economists on both sides of the equation. And so that's where you could probably pick your economist and back to kind of your commentary about some people see it this way or some people see it that way. I think people should just admit they don't know exactly how it's going to turn out. And that's where, to me, that, I think that's spells, diversification, not concentration, which I know is highly unpopular right now. Having done this for 31 years, throughout different periods of time, I've heard the word diversification. And usually when I hear that word, diversification is about ready to work pretty well. And so that's where, maybe using some of the historical analogies, having done this for 31 years, I think it's important to kind of think about. And just one thing, I know maybe we'll get to this later. I do think, and I do look at history quite a bit for clues about what may happen. Some people think and use that commentary that the world has changed. I don't disagree, but I think history does work fairly well. And that's because we're all economic agents. So we all control what happens in the economy. We also control what happens in the markets. And we've all been behaviorally flawed in the same manner for the last 150 years. Meaning that we have all the same biases that we've had throughout time. And we're the ones who impact what's happening on that stock market screen. We're the one who make business decisions. And that's where I think there is quite a bit of truth in looking at the past. And I do see the world through that lens just a bit, acknowledging that things do change. But I think that's always a good starting point to look at. And tied to these tariffs, like you said, 1933, that's a long time ago.
So you mentioned concentration, and that's where I wanted to go next, because I believe the Mag 7 is now about 34% or so of the S&P 500. Depending on how you look at it, that's certainly one of the higher concentration levels in history. And you've kind of got two sides to that. Some people say, these are the absolute best companies in the world. They deserve that. And, if concentration keeps going up, not a big deal. Other people think that's somewhat of a risk. So how do you view that concentration, particularly when like a lot of investors who own indexes actually are concentrated in a certain number of names?
Yeah, I always say asset classes don't die, they just go to sleep for a while. Companies do. And that's where, do you want to put, if you only owned, and I think people think they diversify by owning the NASDAQ or the Russell 1000 growth and the S&P 500 or whatever it may be, but do you want to put your future and your family's future in the hands of a few companies? And that's where, from the standpoint of just risk and whatever else it may be, I've seen people win magnificently, not a pun intended, but it came out, I guess, right? Win magnificently by being concentrated, but I've also seen them lose magnificently. And that's where, at least historically, the opposite side of these concentrations has resulted in a broadening. And I believe there are studies, and I haven't read about them for a while, and it was not my study, but there was one going back, I believe, to 1957 that talked about in the year after being in the top 10, if you would have used that strategy, I believe you underperformed by a few percent, maybe 2% over that longer time period on average every year, which is quite a bit of wealth that goes away. I think I'm somewhere in the middle. And so I think you should have exposure to these names, but this is where I think the market is going to broaden back out. And I even bring this back to 1999 when the market was similarly concentrated. And I had a lot of people who only wanted to own those names. And if you think about Cisco back then, and I know people make the comparison, it's kind of the NVIDIA of today, and it was kind of laying the train tracks for the internet. And that's where a lot of those stocks were also in the NASDAQ. And that's where if you would have bought at that point, the internet became something that was very real and very tangible. But most of those stocks, including the NASDAQ or the technology sector, make a new high for 17 years. And the benefits eventually have to shift, I think, for that spending to continue just like today to the companies that use that. And that's where there was a study out last week, and this is where I think there's questions on AI right now, although investors are going to buy any dip, it looks like right now. There are questions about how are companies using AI right now? Are they using it to increase their revenues? And at least I think there was an MIT study last week that suggested that as of now, 95% of companies haven't figured out how to use generative AI to actually increase their revenues. Not a comment on whether AI is good or bad, just a comment on right now, not having figured it out. And that's where, if you think of nothing else in the future, this will benefit companies like probably the one that's on my wall there in the future, increase their margins. And that's where I think back in 2000, when that all shifted, and I used to travel around the country because everybody thought it was a lost decade, and it was 2000 to 2007. So before obviously what happened in '07, I think the S&P 500 did about 1%. The S&P equal weight, which is something that I think, if nothing else, I embrace that from an anti-concentration bet. That was up 6 or 7 per year. Small and mid did quite well. So it was more of just a lost decade within those names. And that's where, if nothing else, hopefully history gives you some perspective there. And then I talked about the 70s, which was the Nifty 51 decision stocks. Typically markets broaden back out, especially in a country as diverse as the United States, where I think we're all learning, yes, we do have a lot of imports, but not much. And we are kind of an odd, large, closed economy where most of what we can actually do or consume actually happens within these walls of this country.
It's funny, like I'm a value guy, and I always look at the data historically. And as you know, like if you look at the data historically, like what are the top 10 companies in the S&P 500 every decade? They almost always change.
They do.
There's almost no consistency. But then like I try to challenge myself and say, is the edge these companies because of technology or because of what they're doing in AI? Is it so extreme that maybe that's not going to happen? But then I kind of flip back and say, well, did the edge of all those other companies look to be so extreme at the time? So I think it's an interesting discussion. I really don't know the answer.
This is where I think most people who buy individual equities these days are buying off earnings revision. And that makes sense. Going back to my narrow economy, people are going to where the growth is or where the earnings are being revised higher. And that's why you have some stocks that are large, big box, and I don't know if I should name stocks, that trade at 40 to 60 times earnings. Something that would make a value guy like you, Jack, probably not understand why that actually occurs. But that's where you're seeing a lot of earnings revisions. I think going back to being more of a value person, and this is where I think valuation always does come in at some point. No one just tells you when that trigger actually is. It is, you have to think about what you're paying for those earnings, what you're paying for that cash flow. And that's where, I think a lot of those companies that were in the top 10 in 1999, I think Microsoft was one of those. They actually grew their earnings, but their stock price didn't grow just because it was already discounted. And that's, I think, the question you have to ask going forward is how much of this is already discounted? How long are these trend lines being drawn into to perpetuity? And what actually happens from going here. And at least history would provide a cautious tale of concentrating in any one particular segment, because at least historically, the winners across the decades, they change and the themes become different.
So you mentioned diversification a lot, and I know you focus on that. And so I want to ask you about diversification in the world we're in from two perspectives. The first is this idea that, most people have something along the lines of a 60-40 portfolio. And within that is this idea that stocks and bonds are enough to be diversified. Like, what do you think of that idea? Do you think that changes in a world where we have inflation?
That's where I encourage people to own some real assets. So we do have commodities in our portfolio. And I think, people don't love commodities, at least because they didn't do well from '08 to 2020, 2021. Commodities provide their best returns typically when those other two asset classes don't work. And if you look at 2022, I believe commodities were the top performing asset class. Just a dumb stat because I'm full of these. since 1926, I believe the market's been negative 26 times on an annual basis. Bonds hedged it in 21 of the 26 or were up. This is just the S&P 500, which will tie into my second comments here. That's where, so 21, 26 times bonds worked. The 5 years they didn't, 1933, 1946, 1969, 1973, and 2022. In 4 of those 5, commodities were up double digits by quite a bit. The one that didn't was 1933, which was during that thing that we don't want to have repeat, which is kind of that, Great Depression. That's where I think hopefully people see that as a worthwhile hedge. The reason why it didn't work from 07 to 2020 or whatever it was is because we weren't worried about inflation. That's where that one side of the Fed's mandate, we had low inflation for a long period of time. If you think a higher inflationary period going forward, I would have to imagine commodities would participate fairly well in that. And that's a broad basket. It includes oil, it includes gold, it includes silver, it includes industrial metals, it includes agricultural. And that's where I just think I would advise people, if they're thinking about hedging a portfolio, hedge both sides of the equation, not just, back in the day, it was you own long bonds. I don't know if people remember that, but from 08, 09 to 2020, long bonds were the only protection that you needed. I used to joke that they protected you against everything. Now I just think they protect one side of the distribution. The other side become just as likely, and that's where I'd encourage you to own those other real asset types things. The other thing is that the 60-40, I think, is predicated on the S&P 500 and the Barclays Aggregate Bond Index. And this is where I think a 60-40 still works. In fact, it may actually get some lift from actually bond yields being higher. So there's always these articles that are written that, 60-40 is dead. Usually when people write those, I encourage you to buy it. Because that's where, in this time, I think, if you look over the, that same time period, bonds basically did nothing and stocks provided all the heavy lifting. I think bonds in the 4, 5, 6% even provide at least a better balance on the one side of the equation. And then I think now you have to think not just 60% in large cap, but in other parts of the market, in other asset classes, even international stocks, which I do think the path forward for what the administration is looking to do, which is help our trade deficit, bring manufacturing back, make our goods and services more competitive overseas, is a lower dollar. And a valuation measure there is called purchasing power parity, which would indicate that the dollar is expensive. And so if you want one metric to kind of guide you on your thinking on whether or not international stocks, at least historically, it's been the direction of the dollar. And I think the dollar is probably poised to move lower. Not a comment that it won't be the reserve currency, but a comment more along the lines of that you want to make sure that you own some international stocks in that 60%, as well as small and mid cap, as well as things other than just 10 companies.
To your point, when you start seeing in the media tons and tons of articles that anything is dead, usually it's time to maybe at least take a look at the other side of that.
100%. Yep, I agree. And I'm a natural born contrarian, I suppose, in many ways.
Other than Fartcoin, because when the articles come up that that's dead, that probably is actually going to be dead, I would say.
Paltry, but no. So this is not an advertisement we put on there to buy Fartcoin or anything of that nature. It's just an indicator.
No.
It's a lot of these meme coins. I mean, they don't really serve a purpose, and they're, but that's where I think there's just excess cash that's still out there sloshing around trying to find a home, and it's found a home there.
How about diversification within the 60, within the equity part? Many people argue the S&P 500 gives you everything you need. It's the biggest companies in the world. It's tied into the economy. People like me might say, with this kind of concentration, maybe a little value in there wouldn't hurt you, or some international might be okay. Like, how do you think about that?
All the above. I mean, that's where I think it's going to be. I think the market's going to broaden to be more than just those 10 names. It'll broaden to be more of the S&P, where there are plenty of names that haven't participated the last few years. That doesn't mean that there won't be companies that go out of business or those sectors, or the sectors to be in, from an explosive growth perspective. I think small and mid cap stocks. Here's an example. So I mentioned 1999, and I mentioned a narrow market where all my clients, and I started out in a high net worth portfolio manager for ultra high net worth individuals. I couldn't get anybody to buy anything other than, they didn't want to buy anything other than large cap growth in those 10 names. I think I made a comment earlier that small caps and mid caps traded their cheapest relative valuation to large caps since the year 1999, 2000. And that was a really narrow economy because of, I mentioned before, the Fed had been raising rates. The economy was late in the cycle, but we had the Y2K spending, we had the internet spending that I think kept us going. And on a valuation basis, we're at the second cheapest. The other cheapest was the end of 1999. If you look at 2000 to 2025, even including the last 6 years where large caps have dramatically outperformed everything, and the return on mid-cap stocks in that 25-year time period, 9.7%. Small caps, annualized. Large caps, 7.7%. And so they've outperformed even with that. And that's why I think right now, just given all the uncertainty that's out there, we've pulled back and kind of more focused on valuation. And so I want to be cautious. I want to own both sides of distribution. We were overweight equities for a large period of time when I first came here. We were a little bit more cautious right now. But the irony is, even in being a little bit more cautious, is we're tilted towards small and mid-cap stocks just because of that valuation perspective. And so think about that as planting some seeds that I think I'll be able to harvest in the next few years. Timing uncertain, but I think, at least now we're seeing a little bit of a rotation. Then even on the international side, it's been out of favor for some time, but I do think the dollar is likely to falter in the coming years. And that's where I think international stocks will outperform. And maybe just a fun fact, kind of tying it back to late 1999, that was a period of time where the U.S. was exceptional. Foreigners wanted our markets. Everyone wanted our markets. I know the profits of the companies are maybe a bit different now, but the PE ratios were similar. The CAPE ratios were similar. Actually, the CAPE ratio today is higher. But that's where the dollar index is, I believe, is at 120 in 1999, 2000. It fell to 70 by the year 2010. That made the U.S. more competitive on a global stage. That helped eliminate our trade deficit ex petroleum. And that actually was a decade of international outperformance. And so I think there are just a lot of things that are coming to fruition here that I think change kind of leadership going forward. It doesn't mean that you shouldn't own the S&P 500 market cap or whatever it may be. But to me, it just makes you want to hopefully not concentrate.
You mentioned working in the business in 99. Like, what do you take away from that? Like, what are your biggest lessons from that? I mean, I had just started my career and I was working for an internet startup and I was convinced I was going to be a billionaire, and that obviously none of that worked out for me. But like, having lived through something like that, what are the biggest lessons you take that you carry to what some people might call a similar situation here?
I just think there are lessons throughout history. If you look back historically, so let me give you some more numbers on end of economic cycles and how markets tend to concentrate. I wasn't doing this in 1989. I don't know if either one of you two were, but in 1989, if you think about towards the end of that, international stocks had outperformed the U.S. markets, and it was being driven by this country called Japan. And Japan went parabolic. I imagine if we had clients back then, everybody would have wanted to own Japanese stocks. The Japanese market didn't make a new high, I don't think, until a couple years ago, if you would have bought, unfortunately, at that high. 1999, 2000, I was a young analyst, or a young person in the industry. I started in 95. And I remember someone coming in and saying, Brent, you're a young guy, and we're talking about oil prices. I think oil was at $12 and he was telling me that oil was going to zero, or $3 or $4 because the U.S. was the world's largest consumer of oil. We were a services economy. Everyone wanted to own large cap growth stocks. No one wanted to own emerging markets or international stocks. It was hard to convince anybody because the U.S. was the best performing area, and that's where you wanted to be because the internet was going to drive us higher. What happened over the next 7 years? The asset class leadership board exactly flipped. This little country named China came aboard, pushed international or emerging market stocks, I believe, up 23.9% per year. I'd have to check that, but that seems like the right number. Europe, developed market stocks, international stocks, number 2. You want to know why? This little thing named the euro was created, which allowed Portugal, Ireland, Italy, Greece, and Spain. Do you all remember the pigs? To borrow too much, party too hard, and that pushed their stocks higher. And everybody wanted European stocks towards that. Commodities. Oil didn't go to zero. It went to $150 a barrel in some major firms towards the end of 2007, and commodities did very well. They were tied for second. Everybody wanted to own commodities. I remember in 2007, 8, and 9, sitting around and people were talking about, and I should say large cap growth, those tech companies didn't make a new high for 17 years. Unfortunately, you bought at the high. Then I think about 2007, 2008. Do you all remember the conversation? What everyone wanted to own then? It was commodities, emerging markets. I remember a prospect telling me, I worked at a bank, and coming in and saying, you know what? You guys are just way too old fashioned. This diversification thing, this adherence to history, everyone knows it's a no-brainer. Remember my cues earlier? Everyone knows that China is going to outperform the U.S. for a long period of time. It is going to become the world's dominant economy. That's where I want more of my money. 15% in emerging markets or whatever else is not enough. What happened since then? I don't know if China's made a new high yet. Europe finally made a new high. If you wanted to buy Portugal, Italy, Ireland, Greece, and Spain, Europe finally made a new high, I believe, in 2022. So whatever 07 to 2022 is. Commodities, oil went back down. Commodities were the worst performing asset class. And I just think, if nothing else, hopefully just tell you a story about how all these things change, how things that seem so certain in the future have, at least in my career, been so uncertain. And that's where I just think maybe humility is what you learn after doing this for 31 years. And so that's the base case of all of what we do. It doesn't mean we won't make tilts. We won't make tweaks. We don't do individual stock selection. We do. But keeping that base case of a balanced kind of outlook and thinking longer term about how these things should line up on an efficient frontier based upon risk and return, and then making tilts from there, not either all in or all out, based upon something that we believe is going to be 100% true in the future, because at least in the past, that hasn't worked.
We've talked about the S&P 500 and indexing as part of this conversation. And obviously, there's been massive flows into these major market cap weighted indices. And I'm just wondering if you have any thoughts or opinion on if you think those flows are influencing the largest stocks. And this comes out of, we've had a couple of people on the podcast that have really tried to, made strong arguments that, with these being in 401ks and just this automatic money being pumped in, plus the S&P has been super hard to beat. So it's like, if you're going to allocate to it, investors are just throwing money at it. And I'm just wondering, do you have any thoughts on the impact of those flows on the largest stocks in the market?
I'd have to imagine it does. I haven't done any particular research on it, but maybe this prompts me for another kind of commentary, because I think people view active management as being somewhat dead from the perspective of stock selection. And this is where I just think it's hard for any active manager to keep up with a concentrated index, because for the most part, they're not going to overweight those certain stocks. And I think about even looking at just the history of active management. And I think, the period after 1999, 2000, which was an incredibly tough period for people who were in active management. And I did flirt with that a bit early in my career. I think the 01, 02, 03, 04, 05 time period was much better environment, much more a fertile environment for active management, because the market didn't broaden back out. People used some sort of valuation tools a little bit more, like Jack mentioned before, which is what most managers have as part of their process. And that's where we do have exposure to both active and passive managers in our portfolios. I don't believe one is particularly right. It's what viewpoint do I want to express? And then how do I want to express it? For example, for the most part, if we do a tilt. So if we overweight large cap, or if we overweight small cap, or if we overweight mid cap, I usually do that with an ETF or an index, because I did my research on the index. I typically try to partner with large cap or different managers that hold their securities a bit longer, are a bit more steady, have at least a decent amount of active share. But I know that wasn't the original question. I have to imagine it is distorting things just a bit. And certainly those flows, I think from a certain perspective, you're just buying those stocks over and over again. So perhaps it does have some sort of an impact there. But this is where I think if you asked anybody on the street right now, they would probably know, not just like Main Street, they would probably know the names that have done well, and perhaps they're buying those individually too. And you have seen those levered ETFs, unfortunately, pop back up kind of in terms of what people are actually buying right now.
No, I'm really glad you went to active management, though, because one of the questions I wanted to ask you, and I'm sure you're familiar, do you know who Michael Mauboussin is?
I do.
Okay, so one of the things that he's talked about is trying to determine, when you're looking at an active manager, between someone who is lucky versus skillful. And I'm sure that you and your team, your due diligence team, you're the CIO, so I'm sure you've looked at hundreds, maybe thousands of strategies and managers over time. So how do you assess an active manager, and what do you look for to try to determine whether there's actually true skill, there's true alpha generation and potential there?
Yeah, luckily I get to outsource most of that. So
I have a nice.
that. I don't think there's a good answer, because you can certainly be lucky for a large period of time. I think if you can look over multiple cycles and how they did during those multiple cycles, if you can think about, should they be doing well or not in this current environment? Is it an environment that favors what they're looking at, what they're doing? I think the fear that I always have is that people fire managers at the wrong time, even though they're performing as you might expect. And then the world changes. So it's always a battle where people want to only have the funds that have done well recently on any list that they can buy. And that right now would point to a lot of growth funds and a lot of momentum funds. And people are using just momentum as a variable, which I'd prefer not to pay for. I'd prefer to just have that through an ETF. But that's where I don't think there's one hard and fast rule. I think it's how we put these different managers together. To me, that's where my passion is, and making sure they have exposure on both sides of the equation. And so we do have quality managers. We do have value managers. I would probably tilt more towards the value side of the equation today, like Jack had mentioned, because I do think people will start thinking about whether or not they want to pay these higher prices for those earnings and what happens in those earnings going forward. But that's where, I think the answer is a little bit more complex, and I would defer to the man that you mentioned before, kind of as the arbiter of how to do this appropriately.
Stepping out into the headlines for a second as we kind of wrap up here, do you have any thoughts or opinions on sort of this Intel thing and the U.S. government taking a 10% stake in Intel? I'm kind of like a free market guy, and I like to think like government shouldn't have its like hand and stuff like that. But I just, I'm trying to get a diverse set of opinions from smart people as to, how people are thinking about it. Because the market just seemed to, actually the market, I think Intel was up on the news. So like investors were positive on it, but to me, that doesn't seem like a positive. So what am I, maybe I'm missing something. I don't know.
I skew more towards you. I think that's where some of these things are still so early on. And I think if they were to announce more of these quote unquote, I think Howard Lutnick kind of mentioned before, maybe this is a blueprint for the defense industry. I think it causes inefficiencies. I don't know that it's and that's where I think, back to my comments earlier about the U.S. economy being large, being able to adapt around different things that occur, even though they might not be the most efficient, it will adapt around it. And that's where it is a bit concerning. I would throw it all into the bucket of all the different change that is occurring seemingly all at once. And how is the market absorbing all these different things that are occurring that haven't really occurred as much in the past? I know the U.S. government's taken stakes in various industries before, kind of the auto industry I think about maybe, and I suppose you could equate TARP to it. I do think it's different. It certainly doesn't feel right from the standpoint of that perspective. Where it goes from here, I don't know. And is it truly a national security thing? That's where I think if it were, and if it is, that maybe is a little bit of a different story, but it's different. And I think we'll see how it turns out. I think most of the textbooks that I have read would suggest that it's not the most efficient manner in which to run an economy. And there's all kinds of knock-on effects that could happen that are not probably in that kind of efficiency category.
So we have two standard closing questions as we wrap up here. The first is, what is the one thing you believe about investing that the majority of your peers would disagree with you about?
I don't know. To me, it's I think we all have a process. Hopefully, I think we manage money for different constituents. And so to me, my words have a bit more of an impact because I have a lot of retail investors, and I've built my process around that. I've built my commentary around that. I try to be more approachable and understandable. When I was younger, I wanted to be thought I was smart. Now I just want to be understandable and approachable because I think that leads to better decisions by our clients. And I try to explain things in ways that they can understand. And I think that builds trust. And so, there are other people who come on here and will tell you exactly what they think is going to happen in the next few months. And they may be wrong and they may make big tilts off it, but they're trying to sell their research to hedge funds or something else and making big decisions off it. And so maybe that's how I'm a little bit different. Some people say that because I'm in Milwaukee, Wisconsin, I'm more Main Street, not Wall Street. I'm not for sure that's the case. I just think it's the way that I've kind of thought about these things. I do think, as I mentioned before, that history and the markets rhyme a bit more than what people imagine. Whenever someone goes on TV and says, and I heard it again yesterday, listening, the economy is not the markets and the markets are the economy. If you haven't kind of caught that drift from me, I think they're the same. I just think sometimes it's not perfectly evident. And so that's where I think it's logical that those 10 stocks now make up such a big part of the index, because that's where the earnings growth been, because the rest of the economy has not been doing so well. The last thing I think, and this is where I think people don't necessarily learn from history. So at least I try to learn from it. I gave you some of the tales that I've told before and some of the things that I've seen. I fear right now that a lot of Wall Street thinks they exist to help people take risk. And I don't think people need help taking risk right now. I think they did prior to 2020, 2021, 2022. But I think now people need someone to kind of make sure that they're staying truer to their risk tolerance. And that's where I just think, perhaps I come off a bit differently. I tend to think of the same things. I'm not going to try to time something perfectly. I have tax considerations. I try to set it up a little bit more for the process that I think works well in high net worth area or even mass affluent. And I think my biggest difference probably is just that economy and markets. And then, I think most people kind of skew towards the risk side of the perspective right now. I kind of think about maybe how I answer to the other questions is, can you do this through a whole cycle where you have the ups, the downs and the backs and the force? And I just think now if I'm not talking about caution, knowing that no one tells you when the world's going to change. For example, I hear people go on TV and say, yeah, let's stretch, but this could continue for a while. The problem is no one tells you when it's not going to continue. And no one rings that bell. And then it all happens within a few weeks. And then all of a sudden you're sitting there going, my gosh, why didn't I do X, Y, and Z? And so I think I just think a little bit broader than most people and try to be a little bit more humble than maybe some of the others that are out there that, I think that's what they have to do because they're in the world of showing the research. I'm in the world of actually managing people's money.
Yeah, that's great. And lastly, in closing here, based on your experience in the markets, what's the one lesson you would teach your average investor?
I think just the humility and not knowing exactly what it is and trying to ignore your urges just a bit and making sure that you're sticking to the process. I mean, we're all humans, right? I'm human. I have emotions. I wake up in the morning, I'm like, oh my gosh, is this really happening again? I mentioned COVID before. Once in a lifetime, same as it ever was. I do receive quite a few emails, as you might imagine, given my our large network of advisors. And people during COVID were saying, what are you going to do? Like all the things that you've learned in the past, they don't apply anymore. Like, because I was the one who thought the Fed would throw tons of money at it kind of back earlier. The fiscal policymakers, the monetary policymakers I thought would pull out all the different acronyms they pulled out during the financial crisis, and they would throw all kinds of money at it. And the fiscal policymakers too, why wouldn't they? Rates were low and, our debt was higher, which we didn't really talk about debt. Maybe that's an interesting topic to come back to because I think that's actually an issue going forward. And that's different from what I've thought in the past. But that's where, I went for a walk in the woods. I went back to my process and my answer was once in a lifetime, same as it ever was. And that's where I think, if nothing else, you're an average investor, stay balanced. Like stay, that to me, I don't think anybody's found a better way than diversification. Certainly concentration can be much more exciting. Unfortunately, having done this for 31 years, I've seen plenty of people who have concentrated and they had the exhilarating ups, but then the exhilarating downs. And I just think being balanced, staying true to an investment philosophy and process and not letting anything move you too much, I think is highly important. And that's where I would tell people that goes back to just being diversified. So.
Great, Brent. Thank you very much. We've enjoyed this conversation. It's been good.
Absolutely. Thank you all.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.